Back again for the monthly commercial real estate trends webinar. So I'm joined by the usual crew. For those that are new to this, allow me to introduce you. We got Lon Welsh and Eric Ross on the same camera. How you guys doing?
Fantastic. How are you?
Outstanding. Thanks for letting me be here again.
We've got Joe Massey here with Castle and Cook. How you doing, Joe?
Doing great. Nice to see you, gentlemen, as always. Appreciate you guys having me on.
Heck yeah. Well, I appreciate you guys all joining us. It's as we get into the summer evenings, it's always there's a lot of beautiful days out there in the evening. So really appreciate you guys joining us here. So we're going to go through the usual stuff here real quick before we get into it. We've got a chat box on the right-hand side. So feel free to send over your messages or your questions. We will work to address them as we go.
Right. Why don't we just skip through this to the level that you're familiar with?
You want me to go through this?
Sure, why not?
All righty. So many of you probably seen this before. We got to discuss this at the beginning of every presentation here. So love letter from our attorney. So Ironton Capital, we are hosting this real estate trends webinar here. Everything we're going to go through today is it's all going to be data. It's going to be numbers. It's going to be industry real estate focused. But if you do see anything pop up in regards to when we reference Ironton Capital Funds, please know that anything in that regard is confidential. So any investment in really anything does involve a high degree of risk, especially in private equity and real estate type investments. So you may see some forward-looking statements, words like projections, targeted IRR, et cetera, et cetera. If you are interested at the end of this presentation, if you're interested in getting in touch with us and learning more about Ironton Capital and our funds, please feel free to reach out to us. And always know that at any point in time where you do decide that you might want to invest with us, please make sure that you get everybody who is involved in your decision-making process involved before making any kind of commitment.
Let's see. So real briefly, the investment team at Ironton is myself, Vital, and Brent Geyer. We've all been working in real estate for over 20 years, investing for all of that, and lots of experience. I'll let you read through all those details on your own. And we do offer a bunch of different fund solutions depending on what it is you're trying to accomplish. So we've got a diversified fund that's long-term growth, no liquidity, but usually like a 17 to 20% annualized return. So for those of you who are tired of being landlords but still want to have exposure to real estate, that's a really great diversified way to do it. And if you have to sell an existing piece of real estate to invest in it, there's some tax shelter things to minimize the capital gains impact. So I can talk to you, or Nick can talk to you about that. We have a short-term and a medium-term income fund if you're more income seeking. So depending on what kind of liquidity you need, or if you need tax advantage status or not, we've got two different solutions there that Nick and I can tell you about. And occasionally we'll have a single asset fund, and those are just really fun products that we get every once in a while. So the game plan for today is I want to talk a little bit about the Denver real estate trends. I know probably about half of you guys are here mostly for that, and this will apply both to residential as well as commercial. And then we're going to talk a little bit about the commercial rental trends on the back half of this. So for those of you who are owner occupants, I'll tell you when that transition sort of occurs. You guys can all sign out. You're welcome to stay if you want, but of course I wouldn't expect you to. There is a chat box on the right-hand side, so feel free to punch questions in as we go, and I'll try to answer all those. It certainly makes it a lot more entertaining for us. So this map is a brand new map, one we've never had before, and this is based on months of inventory. So if you're not familiar with it, months of inventory is my favorite leading indicator of what's going to happen next to the real estate market. And the way you calculate that is if you take a look at the number of sales that took place in the last year, if the buyers kept buying at that pace with the number of actives I have today, how many months would it take to sell every one of those listings? And if we're below 4 months, there's too many buyers, not enough listings, and the seller's going to have the upper hand in the negotiation. If it's more than 6 months, then there's too many listings, not enough buyers, and the buyer is going to have the upper hand in the negotiation. If you're between 4 and 6, it's a pretty balanced fight. Everyone's got kind of an equal chance. So for the entire metro area, there's a little bit less than 3 months of inventory, which would be a seller's market. But that's like me telling you the average temperature in America today is 78 degrees. Is it going to be hot in Denver? Well, that doesn't tell me anything. We need to know at a neighborhood by neighborhood level to be able to make really intelligent decisions, not only about should I buy or sell, but what kind of negotiation strategy, how much leverage do I have with the other party. So we calculate this for all 500 different neighborhoods. So this is Central Denver, and the 4 of them that are in the red circles are the one that I want to point out to you. So take a look at the upper one. That's Highlands East, just outside of downtown. You can see that the average price there is 1.2 million. We had 74 sales in the last year, but most importantly, at the moment, there's 7 months of inventory in the Highlands. So the buyers, for the first time probably in about 10 years in that neighborhood, have got the upper hand in the negotiation. I have not seen that in a neighborhood like this in a very long time. So if you've got buyers who have been frustrated, particularly if like they're looking in 21 or 2022, where it's a very extreme seller's market in almost every neighborhood, shoes on the other foot. In some neighborhoods right now, most of them are balanced. If you take a look at West Colfax, that's a little bit on the left-hand side, a little bit tough to read there, 7 months of inventory as well. If you take a look in the lower right-hand part, Cherry Creek and Belcaro, 7.5, 6.5 months of inventory. So the prior period for Belcaro, you can see, was only 2.2 months. So there's been a huge amount of inventory build just in general, but disproportionately so in Belcaro, where we went from 2 months, a seller's market, and a pretty strong one, to 6.5 months to being a buyer's market just in the space of 1 year. So if this is useful information to you guys, you can email me and I would be happy to send you a poster size of this for the entire metro if you need that. We have it for Colorado Springs as well. Any questions on that? Joe, I don't even know if you've seen this before. It's like brand new.
Yeah, I looked at it the other day when you sent it out. I think this is a great way to analyze this. And I suspect in 90 days, when we have another quarter of data, we're going to see more buyers markets. I might be wrong about that. I don't know if we'll see 6 buyers neighborhoods or 8 or 10, but I think we're going to see this trending up a little bit, but I could be wrong.
I bet it'll be over 20.
Yeah.
Yeah. So we can bet a bottle of wine on that maybe.
That sounds good.
All right. That's the first one. So let's talk about the key messages for the Denver homes and condos. If you take a look at the average sales price, you can see for homes, we've had a very modest amount of appreciation, not quite as much as inflation, but not bad. For the condos, it sort of averages out to close to 0, but it's been flat. So if you think back to about this time last year, we were forecasting that sales volume would be down a little bit and the prices would be roughly flat. And that's kind of exactly how the year ended up working out. Looking at next year, I'm anticipating whenever we see mortgage rates drop at a meaningful level, and Joe's going to talk about that in a couple minutes here, we're going to see the pent-up buyer demand rush into the market relatively quickly to capitalize on the low rates. You won't see sellers come on the market nearly as fast. They're already listing their properties, so they jumped the gun there.
Yep.
So when that happens, I'd expect that you're going to see a tilt from a relatively balanced market now to back again to more of a seller's market because the inventory won't come as quick. So it'd be a really good strategy to try to buy something now, take advantage of the negotiation environment for a buyer, and just refinance this thing in a year when the rates drop. I wouldn't necessarily wait for the rates to drop. And Joe will talk about that in a lot more depth.
Yep.
Months of inventory, 2.6 for the homes, 3 for the condos. So it's still a seller's market, but just barely. If you take a look at the number under contract, you can see that we're down a little bit from this time last year on the homes, down quite a bit on the condos. Joe, what's kind of your feedback on the condos? Is it the spike in the insurance rates and spike in HOA fees that's driving the reluctance on the condo side, or what are you seeing?
That's exactly it. I mean, the flat cost of owning a condo right now is, even if you pay cash, is like $800 to $900. You have $400 a month for HOA. You have $200 a month for property taxes, and you've got another $100 a month for your HO6 insurance. I mean, $700. It's very easy to have a $700 a month payment before you even talk about interest rates, before you even talk about a mortgage payment. So condos are getting stifled a little bit by HOA increases and insurance increases.
So, Eric, from an investor standpoint, are you still seeing that the rental condos that you manage, are they still renting out pretty well?
And obviously, like any other asset, it's a commodity. So based on price, or condition and location, if priced appropriately, we can still move it in that 2 to 3 week time frame. But you're not seeing the gains that we saw at the latter part of the teens and over the last 2 years. So rents are relatively flat on the condo side. And especially in that kind of C plus B minus asset class.
Okay, that makes sense to me. Sales count, you can see a lot of red ink there. I think the mortgage rates, Joe, mortgage rates roughly this year versus last year have been stable to relatively stable, right?
Relatively stable and even down a little bit, especially compared to late last year. October of last year, peaked just about 8%, 7.9, today, 6.5. So a lot of people are like, man, 6.5 seems so high. Yeah, it is, but it's a point and a half
About 8.
better
It's
than
not 8.
10 months ago. We're moving in the right direction slowly.
Yeah, so I think a lot of the reduction that we're seeing in the sales count, we can't attribute that to mortgage rates because it's been a relatively consistent environment. I think the spike in the taxes and the insurance and the HOA fees is probably the culprit there. And you see that the number of sales in the condo is more severe of a decline than we see on the single families. HOA there probably is a big driver for that. Also, those are first-time buyers more likely than homes are, and they're a lot more down payment sensitive and payment sensitive, I'd imagine, aren't they, Joe?
You're exactly right. When you see interest rates go up, there's a certain number of people that can't qualify. And who are those folks? Generally at the lower end of the market. You see HOAs go up, knocks more people off the table. Where does that happen? At the lower end of the market. So there's just fewer people buying those first homes or that are able to buy those first homes or first condos than there were a year ago, 2 years ago, 3 years ago.
That makes sense.
And one point on that HOA fee increase, the number one driver there is insurance.
Oh, yeah.
So insurance is just getting really challenging with these larger condo developments, and they've got all these roofs, and hail is the number one driver here. So not only are we seeing that on the condo side, but our kind of mid-sized multi 8 to 12 units, we're really seeing a significant office as well, a significant increase in that insurance cost, which I think is driving that overall.
Yep.
Yeah, all big factors for it. So as a result, you can see on inventory that we've seen a big build on homes from 3,500 to 5,800, and the condos have nearly doubled. So a lot easier for the buyers than it has been. So this chart, the heavy blue or green line shows you the number of active listings, and it's a sawtooth pattern. You tend to have more actives in the summer than you do in the winter time. So you've got that sort of sine wave look to it. And then the dashed line at the bottom is the number that are sold each month. So you can see that we had this really dysfunctional market in 2021, 2022, where for a period there, we were selling homes like literally that they'd come on the market, they'd be under contract in 2 days. The ideal situation would be to have the heavy blue line above the dash line. So there's a buffer of inventory. The whole system works just much more efficiently when there's a sufficient amount of inventory. And we're actually in that situation right now, which is nice. So active listings, just to give you some context, this kind of highlights that the summer months have a lot more active inventory than say December or January. And 2024 is the number on the top there. So compared to pre-COVID of 2019, very similar. Compared to during the COVID, a lot more inventory than that. So that just give kind of context to where we are inventory wise. It's higher, but if you compare it to 2019 pre-COVID, it's really, really close. So this is actually like not a bad level of inventory.
Normal-ish.
It's like as normal as this market will ever get. So I was kind of
Yep.
glad to see that. Showing trends. So for July, if you just imagine that line at the bottom, which is the 2024 performance, if it just continued straight on the trend that it's been on, that's exactly where July ended up landing. And the data I suspect you're going to get for August will be very similar. So the showing traffic is a lot less than we saw pre-COVID. Now, I think the line to look at is the heavy green line. That's 2019. And you can see we're a little bit below that, but not dramatically so. So the implication here, if you're a listing agent, is that every showing counts. For those of you who've been in the business for a while, if you can rewind your mind back to say 2009, 2010, those were really terrible years. Buyers just had no incentive to buy at all. They were scared to death. The government actually had a brainstorm of an idea that we're going to pay people to buy a house. That's how bad it was. It's nothing as bad as that, but it is important right now that you convey to the sellers that we're not going to get a lot of showings. And every showing, we want to prep the house, make it look great. We don't want to be unreasonable at saying no to showings. We want to be very flexible about, yeah, you can come on 15 minutes notice and I'm going to pick up, all the kids' toys and diapers and everything else. It's a major imposition on the sellers, but the more flexible the sellers can be to react to the buyer's whims, the easier it's going to be to sell the house. Okay, I'm going to skip that. I do want to talk a little bit about the days on market. So days on market, things will sell a little faster in the spring than any other time of the year. They sell the slowest kind of around Christmas time. So you have this sawtooth pattern. That's the heavy line of how long it's taking to get stuff sold. The dashed line is the weighted rolling average of a 12 months. So it takes all that seasonality sort of out of it. So you can see recently the marketing times have started to increase a little bit. So if you see a headline saying it takes 40% longer to sell a house than it did 2 years ago, statistically that's true, but as Mark Twain said, there's lies, damn lies in statistics, and that'd be a good application of that. If you take a look at the marketing times right now relative to the last 15 years or whatever it is I've got on here, houses are still selling pretty quick. So if it's a good neighborhood and you've priced it right and it is relatively available to show, the house will still sell.
Well, and you've worked in outside markets of Denver, and what's a house take to sell in South Carolina or North Florida?
Yeah, well,
75, 85, 95 days.
Yeah, that'd be it. Yeah, it's not easy to sell a house in those types of markets. So we're still pretty blessed here to have like a lot of demand. It's just not as much demand as it was.
Indeed.
So for those of you who have sellers who are like wringing their hands about, God, I'm seeing all these headlines about, inventory is up and showings are down. Well, that's all true. But what we've gone from is like a manic market during COVID to a more normal market that compared to pre-COVID is relatively similar to pre-COVID performance. And you look at the marketing times here, like they're still better than pre-COVID. So by no means should you be dissuaded from taking a listing right now, as long as you can price it accurately.
Yep.
Okay, Colorado, you can see that recently the inventory is up 39%. For the whole country, it's up 35%. So what's happening for us for our inventory build is nothing unique. It's happening across the entire country. Yeah, Arizona's pretty healthy. So the outliers of Arizona and Florida is that they're both really condo intensive. So there's a larger condo growth than single family. It's exacerbated in Florida because now there's legislation after that condo fell over and killed a bunch of people that if your condo's over, I think 30 years old, it's mandatory that you have a structural inspection. Of course, they're all finding lots of problems with gigantic special assessments. None of these people have any of the money, so they've got to dump their condos at a loss. If we were in Florida, we would talk about that for 15 minutes, but we're not in Florida, so we don't need to. If you're curious about that, call me. I have a condo in Florida, but it's not probably relevant to this group.
Is it going to fall over?
No, it's a townhome. So
good. Okay.
I'm in good shape there. I'm not too worried about it.
Good.
But I tell you what, our insurance more than doubled. And I just got a special assessment from the HOA. So just like everybody else, I'm having some miserable times there.
Yep.
Larry asked, do you feel the Colorado inventory build is mostly in Denver city limits due to recent property changes? I assume by that you mean the changes in the landlord laws making it a lot more difficult. And Eric's going to talk about that in depth in a couple slides here. I don't think so. Anecdotally, I can tell you that there's a lot of long-term investors that are making plans to liquidate their portfolios and roll into passive investing. But none of those guys are guys that are going to turn a light switch. I mean, they've got to wait till their lease is up. If they've got 8 different properties in their portfolio, they're going to do 2 a year over a 4-year period. None of this stuff will come to an equilibrium really quick. I think most of the inventory build is just have the amount of inventory for the last couple of years has been lower than average. So I think people have enjoyed these 3% mortgage rates. But Joe, I'd like your thoughts on this too. I think what's happened is that they've said, I'm not going to move because I like my 3% mortgage, and life happens. I've heard these great anecdotal stories about a couple getting divorced, but they can't give up their 3% mortgage, so that the husband's living in the basement and the wife's living on the first floor. There's only so long you can do that. But
That's
Joe,
right.
what do you think about that?
Exactly that, Lon. I mean, if we go back 3 years, I bet I had 300 people tell me, I have a 3% mortgage. I'm never moving. Cool.
Never.
I completely believe you, right? Guess what? I have now refinanced 4 loans that were sub 3%. I have paid off, I think, more than a dozen loans that were sub 3%. You know why? Credit card debt accrues. They need equity. They need to move because of a job change. They get divorced. They get married. They have babies. Life moves on. things happen. That's why people transact. So we are getting further away from the golden handcuffs. They're still out there for some, but we are seeing life go on.
Yeah. So the point of this slide is that there's a small percentage of people who feel like real estate prices are going to be unstable or slightly decline. So I wanted to show you that over the last 25 years, the average home price has gone up by 300% in America. And in Colorado, one of the top 3 states, prices are up 570%. So if you're worried about not buying today because prices are going to drop, I guess with that kind of a track record, I mean, would you be really all that worried about it? If you're a day trader that wants to be in your real estate investment for 6 months or 12 months, yeah, timing would matter. The typical person stays in their house for 11 years. It really doesn't matter a whole lot. I think the odds of the price of going down are actually close to 0. That's a whole different presentation though. Joe, you've got the crystal ball. It's time to unveil it. Tell us a story about rates.
Oh man, my favorite topic. So we were actually talking about this before we came on the call today, and the headlines out there are telling everybody interest rates have gone down, which is true. A week ago, that average there on the left-hand side of 6.7, that was spot on. There was a lot of turmoil in the financial markets on Friday, and interest rates got as low as 6.1% on Friday. What happened yesterday? Interest rates started going back up, back to about 6.3. What happened today? Interest rates back up again by another quarter to right around 6.5%. So what we're seeing is a lot of volatility in interest rates. But I do think that interest rates are going to settle somewhere between 6.6, 6.3, 6.5. I don't think we're going to see any massive breakout in one direction or the other, but we are going to see a little bit of volatility and some swings. And I really like that average on the left-hand side, or that slide on the left-hand side. We're still historically very low as compared to sometimes in the past. So are we going to see major changes? Maybe, but probably not. And I will tell you the days of 2%, 3%, those are gone. Those are over. But I don't think we're going to see 8% or even above 7% again for a while. I think we'll be right around the mid 6s for a while.
Makes sense. Can you talk a little bit for the investors? There's quite a few of those logged in here today. A little bit how the rates would be for like buying a duplex or buying a quad.
Yeah. So an investment property is always going to be about 0.5 to maybe 0.75% higher than a primary residence. So for primary residence today, right around 6.5, an investment property, 7%, 7.1, and then a duplex or multi-unit quad is going to be about another 0.25% higher. So maybe 7.3, 7.4%, depending on the day. And the reason that is multi-unit properties like that, they're inherently a little bit riskier for the lender, because if you buy an investment property and it's a single family home and we foreclose on it, who can we resell that to? Anybody, any primary residence buyer, any investor buyer. If it's a fourplex and we have to foreclose on that, who are we going to resell that to? Most likely another
number.
And so there's a much smaller pool to resell those properties. So there's a little bit of rate spread built in there because of the risk of what might happen. It's a more risky loan. But again, 7.3, 7.4%, going to be tough to get that to cash flow unless you're putting a significant amount of money down. But it might still make sense if you've got some liquidity coming from somewhere else. Really just depends on the individual property and your individual situation.
Yep. We've got a question. Some potential buyers are hoping for a 5 or 5.5 for a 30-year loan. Will that happen?
Maybe.
I mean, maybe. I kind of doubt it, but it might. I mean, and I think
not this year.
Yeah, the big conversation I would have for a buyer is, why is that number important? Is it because of monthly payment? Is it because of we're just glued to that number for an emotional reason? I would find out why, but most likely you're not going to see that this year.
Yeah, and even next year, I drop another full point. That seems optimistic for even 25, doesn't it?
So
yeah,
Bill's asking, how can
Bill's got a good question here
how can new home builders offer that? That's very simple. It's just built into the price of the home. So they're just charging the client a higher price for the property and giving the client a incentive for a lower interest rate. The client doesn't realize it, that they're paying an extra $20,000, $25,000, $30,000 for the price of the home, but that's how builders do it.
So if you just wanted to go from like the 6.5% today to like, let's say we took a half point off to a 6% fixed, how much would that buy down cost us? Like 4
Probably
points,
2
5
points.
points?
No, two,
Only
two to
2
two and a
points.
half points. Yeah.
Okay. So on a $500,000 loan, it'd be 10,000,
10,
12,000.
yeah, 10 to 12,000.
Got it.
Reasonable.
Yeah, it's not too bad actually. If you're going to be in the place for, what would the break even be on that, 4 years?
3.5 to 4. Yep.
Yeah, so if you're going to be in the property for more than 4 years, it probably makes sense to do the buy down. And Joe, I imagine you've got a calculator that could figure that out for an investor.
Absolutely. Yeah. And I can already tell you 100% of the time, it always makes sense to pay points. I have a lot of clients that look for 0 point loans, or sometimes they want to pay additional points. And I sit down with 100% of my clients and break down, hey, here's all the different choices. If you decide to pay points or you don't decide to pay points, it always makes sense to pay points to buy down your rate. The break even time is generally less than 4 years. And unless you know you're not going to be living in that home for a long period of time, it almost always makes sense.
Got it. That makes a ton of sense. Cool. All right. So 6.5 today, you said 6.6?
Yeah, 6.5.
Got it. So that is the Denver part of the trend. So for those of you guys who are more owner occupant driven, this will probably be the part that you'll have enjoyed the most. We're going to shift over to a lot more investor driven stuff now. So we'll see how many of our viewers like drop off in the next minute and a half. So let's talk a little bit about the laws and things. So can you give us like an overview of last year legislatively, what happened, and yeah.
Absolutely. So 2023, we had 9 new laws that came in. There were some that everybody was really worried about, like portable tenant screening acts. They've become a nothing burger. Prohibited provisions in rental agreements have had some. Pet ownership, we've just changed the way we operate a bit. Not a big deal. Remote participation, yeah, they can show up by video. Again, not a big deal. The biggest impacts of the 2023 laws were limiting security deposit to 2 times rent, preventing a credit check on subsidized tenants, late fees being really ironed out as to what you can and can't charge, only being able to raise rent once every 12 months. But in the grand scheme of things, it has just kind of rolled into the day-to-day operations. And any property manager worth their salt has found ways to implement these laws. I don't want to use the word circumvent, but find ways to
deal with it.
To deal with it in a reasonable manner to continue to protect our clients, the landlord.
Just adds a lot more friction to the process. It seems like at every single step.
It's created some additional challenges on our side. And if you're a self-managing landlord, I can only imagine the mess that you look at.
God save you.
But the 2023 rules were impactful, but not out of control. 2024, a little more challenging. HB 1098 really shook up what we do and how we do around termination of leases, when, how, why, and the operation around it. The days of a terrible tenant being able to be just non-renewed are gone. So we have to have a reason. It has to be material violation, repeat violations, quiet enjoyment, late payments. And that's the one that everyone's like, well, if they're late 3 times, yes, but the statute is about this long and it has to meet every part of that.
Well, all of them.
It's pretty ugly on the late payment. The biggest one that the way we've changed our operation, and I'll be doing a client only webinar. So there'll be some folks that are maybe here that are clients of mine that will get a sneak peek into what we do. But 90-day notice for all tenant terminations, and there has to be a reason. And the easiest way to get them out is refusal to sign a new lease. So you've got to be on top of that. We start our renewal process now at 155 days before expiration.
Wow.
So that's the biggest impact.
And nobody wants to commit that early on. So they can't commit to anything.
They can't.
So then you're set.
So they get a notice of non-renewal. They sign their lease right before. It's the way we've.
So if they sign a month before, it's too late.
No, it's fine. And so we can rescind the notice, but we don't have to rescind the
But you've got
notice.
the option.
So we've kind of taken the law that they created and turned it around a little bit.
I love it. That's
Very
fantastic.
smart.
Thanks, man.
Yeah, I think we're good there. So again, kind of going through the other reasons: planned substantial repairs, occupancy by the landlord or a family member, purpose of selling, which we're dealing a lot with, but you do have to take it off the market for 90 days. And I've had a couple of clients that say, well, what if I try to sell it for 3 weeks and then relist it? I said, you can, just not with me. We're not playing that game with the law. Again, as mentioned, the refusal for the tenant to sign a lease with reasonable terms. The last item is what I mentioned: a history of the tenant's late payment greater than 10 calendar days, more than 2 times, and not cured as allowed under other statutes. So if it's a CARES Act covered property, the tenant can be 41 days late, pay, and they're not late under the statute.
Yeah.
Which is a joke. So it's not one that we're using often. Typically, it's going to be around sale or failure to sign a new lease with reasonable terms. So what it's created for us is the requirement of us documenting tenant misbehavior and posting a notice of compliance. Whereas 3 years ago, if a tenant had an unauthorized pet or smoking in the unit once, or a neighborly dispute, we'd call them up and say, hey, cut the shit, knock it off. And we're not doing this anymore. Now we are required to document that, because that's now a lease violation. And if they pay their rent on time, if they sign a new lease, then I have these ways to dispose of less than desirable tenants. So it's just created a little bit more work on our part. But any PM in the metro area worth their salt is doing a very similar item.
Excellent.
Final item here: if you do post notices, you have to serve them. You have to attempt to serve them twice. First time, if you do not serve them in person. Second time, on a separate day, you can leave a posting on the door, as we've done in the past. The notices must be in the tenant's primary language. So if they speak Swahili, you are posting that notice in Swahili. And
Google
Thank God for
Translate,
Google
Right.
Translate.
right now we have 8 language postings that we do post.
What's your most obscure one?
So we've got a couple in Farsi. We actually have one in Swahili. And yeah, that's the
You can't make this shit up.
Afghan is Pato.
Wow.
So it's been an interesting thing to accomplish, but again, they've only tried to insert hurdles or roadblocks for us to negotiate, and we have.
We'll find a way.
So I think we're good there, Long.
Yep. Solving problems is what the investors do best.
Warranty of habitability, and I'm super careful to talk about this law. So the original warranty of habitability was written over the course of the 2008 legislative session. It had numerous people from both sides of the camps, tenant advocates, landlord advocates at the table. It was an amazingly written law, and it stood very strong for about 11, 12 years. Excuse me. It started to erode. In 2023, they made some updates to it. In 2024, they rewrote it, and this abomination came out of it. It's like a 48-page bill. It's got no less than a dozen contradictions within and on itself. My advice, if you're a self-managing landlord and a tenant says habitability, seek legal or professional advice. There are timeframes that you must follow. You may have to put them in alternative housing up to 60 days. They have increased what is considered life, health, and safety. And I've been doing property management in the Denver market almost 18 years. I tried to read this bill. I don't understand it.
So I think nobody does.
When my tenants call and says mold or moisture or water or leak, and we can't contain it, my first call is to my attorney. And I would recommend the same if you're a self-managing client.
Makes a lot of sense.
So you can kind of take a look here. Literally, this is just some bullet points. I'm actually chatting tomorrow at the Your Castle Company meeting. We'll cover this very briefly, and by very briefly, it will be just that. If they say habitability, please call your attorney.
Yeah, don't get involved. Smart choice. If you guys have any questions, feel free to scroll them down in the comments there. And Eric and Joe are both here to be a resource. That's awesome. Thank you for
Absolutely.
that. Supply side, there's a lot of units that are getting built. So what does it all mean? So it could be as many as 120,000 units across all of Colorado over about a 3-year period, which would be a 12% increase on the supply side. What's not easy to quantify is the really beautiful 3% rate that a lot of people are enjoying. They're financially strong enough that if they get a new job, let's say in Houston, they may move to Houston, take the new job, buy a house there, but they don't have to sell their old house on the amazing interest rate that they've got here. Do you have some clients like this?
I do. We affectionately call them accidental landlords.
Oh, do you have a lot of them?
8 to 10% of the total.
Yeah.
So, I mean, it's a significant enough group that we do have them. And that's whether they move out of state, as Joe mentioned, married, divorced,
Yeah,
kids.
trade up or whatever.
But they have less of a stomach for the day-to-day operation than our investors do.
No way they'd have nearly as much. Joe, is it hard for that person to qualify to get the second house?
I mean, as long as they make enough money to afford 2 mortgage payments, no, it's not a problem. Or if they call a guy like Eric and rent the existing property prior to closing on the new property, then that rent can offset the bulk of the payment they're already making.
It's like 75%.
Yeah, what will you give them, Joe, if the property's got a lease on it prior to closing of the new home? What is that current home worth with a tenant in place?
Yeah, so we look at 100% of the lease income minus 25% for vacancy management and maintenance. So 75% of the total rental income would be a credit towards their monthly payment.
So that may not be enough to, well, if their mortgage is at 3%, that might actually be enough to cover it.
Generally does.
So this is why you're getting so many people doing this.
Yep.
So it's tough for us to quantify, but there's some percentage of these people who are trading up because they have to or moving to a new city for a job opportunity that are keeping their old house. And some percentage of those guys will put it into short-term rentals as an Airbnb, and some will put into long-term rentals for Eric to manage. And that's been more of an uptick in the supply, probably on single families mostly.
Absolutely.
Not so much on condos?
Not at all, because condos are really restricting.
They don't let you do it.
Right. And so just not as much on the condo side.
And you've got plenty of demand on the single family side, right?
We do. And on the condo side, and it is 100% a commodity. So if priced appropriately, I can sell it tomorrow.
Yeah.
My favorite conversation, not theirs likely, is my mortgage is, and I say, let me stop you, irrelevant.
Yeah.
The market is the market.
Yep.
And I understand you'd like to cover your cost, but that has nothing to do with what this may or may not rent for.
Right. That's really important to know. So we've had an uptick in rental supply on the single family side, primarily from this phenomenon, a little bit on the condo side. Most of the new construction, of course, is in multifamily.
In Class A, AA.
Yeah, Class A and Rhino are really ultra premier locations. So to my continued astonishment, we continue to have absorption of almost all of the new inventory as it hits the market.
Yep.
In Denver in particular, but in general, like across most markets across the US. So I know everyone is, I don't know about everyone. There's a lot of people who are frustrated with the immigration issue with all these people coming into America, but they all need a place to live and they're also absorbing a lot of housing. The number of births minus deaths hasn't changed. The number of kids moving out of their house and getting their first apartment hasn't changed that much from historical. Most of the absorption seems to be driven by immigration of all things. So anyway, there's all sorts of pros and cons. I'm not a politician. I'm glad I don't have to figure that out, but I'm grateful that they're absorbing units. So far that's been great. Will that continue for the next 3 or 4 quarters? We continue to have a lot of new development projects that are just about done, just about to get their certificate of occupancy and get delivered to the market. Anybody's guess. My concern, and maybe that you and Joe could
Lon, I think you froze for a minute there.
Oh, okay.
Yep. Could you repeat that question, Lon? You froze for about 10 seconds.
Yeah. So for Joe, and I guess, for you as well,
Mhm.
Eric, we've seen that employment, new job creation is slowing down. Unemployment is going up a bit. Do we think that might be a risk factor for new renters being able to absorb units going forward?
Joe, you're smarter than I am, sir.
I don't know.
I'm just a property
Yeah.
manager over here.
So I'm going to totally give you a non-answer. The
You're a
unemployment-
politician.
Yeah, the unemployment rate that I see, because it impacts mortgage interest rates, is national. I have no idea what our unemployment rate is here in the Denver metro area, but I suspect it's pretty low, probably lower than the national average. So
Ooh.
no, I have zero data to back this up. But no, I'm not particularly concerned about it because I think this is still a great place to live. We have a really robust economy here. We have a diverse economy with all sorts of different industries. So no, I'm not particularly concerned about unemployment in the local market. Eric, what do you think?
So specifically with the asset classes that we manage, and it's funny when I chat with clients, I've got Colfax and Kenton studios that still rent for $9.95 plus $100 a month utility reimbursement, all the way up to Observatory Park or Welsher, $8,000 a month rental. So I've got the full gamut of asset class. The vast majority of my clients and the vast majority of my tenants live somewhere in a B minus to a C asset class. So as the supply comes online, I don't have a ton of this AA stuff that people are trading up into, Rhino and the
Highlands or
yeah. And so I've got some B plusers going to A's, and I've got a couple that money makes no difference, right? They have the means, they're renting because they've chosen to rent. The vast majority, 70% of what I do is in that middle range, and they're not building affordable housing, so it's irrelevant. So I think unless there is a major, change in the economy, as in a 2008, where a ton of those mid-range blue collar service, construction, regular old folks, like myself, gets out of a job, I don't expect
that's
to
a
see
problem.
that's a problem, but I don't think a slight uptick in the overall unemployment. And from what I've seen, it's back to a normal level.
Yeah,
From
being overheated.
being overheated, where it was what, 2.5% to 3%.
It was dysfunctionally low for a while.
Which is that's the absolute zero, because there is a number of people who will be unemployed at any given time. It can never be zero.
Yeah,
Right.
They're switching jobs or they're just not deployable.
Right.
Or whatever their issue is. So I think that's probably more of a risk factor for the AA property in downtown Denver than it is for, those of you guys on the call probably have places like I do that are C quality properties that are
C plus. All of my clients are C plus.
That's right.
C
Even
plus.
high hollows.
All right, they're C.
So, what do you think we're going to see going forward? Well, I think you're going to see increased concessions for sure, where you've got a lot of A and AA product
Agreed.
all delivering at the same time in a knife fight with the existing Rhino properties that can't give up share. Those are going to be very neighborhood specific. They're going to be mostly in buildings with 100+ units, and none of us probably own $100 million asset like that, so it's probably not anything we have to worry about. What do you think for rents? Are you seeing any pressure for rents going up, down? What do you see right now?
So as a whole, we're seeing 3 to 5% rent increases, which is in line with inflation ish.
That's great.
Which makes it roughly flat.
Okay.
So I think we'll continue to see that. I think there's opportunity on under rented or under managed assets. So if you've been with a property manager or you've been self-managing and have chosen not to raise rents for ease, I think you have an opportunity there to see some increases. But 3 to 5% is pretty normal.
Okay.
Typically, we would turn about 22 to 25% of a portfolio annually.
Oh.
That's normal churn.
Okay.
Year to date, I'm at 18%.
Right.
So what that tells me is that, because I'm coming up to the end of my high season, that tells me that less people are moving. They're staying put with some uncertainty, as what we saw last year. So last year we turned about 19.5 to 20% of the portfolio rather than our 25%. So between rates and just some uncertainty, tenants aren't moving just like buyers aren't moving unless they have the means or they have to.
They have to. Something's really motivating.
Yep.
Got it. That makes a ton of sense. So I think from a macro standpoint, you're going to see that rents are going to be flat. I think, the lower end is going to see these rate increases that you're talking about
Reasonable.
on the C and Bs. And I think the A's are going to see, well, the published rates may not go down, but the effective rates will go down because they'll have to give 2 or 3 months of free rent to be able to move a unit if you're in downtown Denver. So there's just too much new capacity all coming out at the same time. And it sounds like you're finding for a nice property priced accurately, they're renting in a couple of weeks.
2 to 3 weeks. So effective vacancy rate is somewhere between, high 4s to low 6s.
That's great.
And that's normal.
Yeah, so that's really good. So no issues there. If you have to evict a tenant, can you give us a little bit of color on, the timeframes on that? How long are you offline?
Absolutely. So it really varies and only varies by, let's call it 21 days. If you're a CARES Act covered property or a non-CARES Act
Can you
covered
review
property.
CARES really quick just for those?
So CARES was signed into law during the pandemic. It created the eviction moratorium on federally backed mortgages. The eviction moratorium went away. The infinite wisdom of the Colorado Supreme Court decided that the way the law was written, it did not have an expiration date on the notice period. So the Supreme Court ruled that if you are a CARES Act covered property, meaning your federally backed mortgage, FHA, VA, Freddie, Fannie, unless you have a portfolio local loan, First Bank, Bank of the West, or
Bank of Colorado,
Bank of Colorado, then the notice period instead of the 10-day statutory is 30 days. So if you're a CARES Act covered property, it's going to take 21 extra days to evict. Simply because they have more time on that notice period.
Is your burden of documentation higher now?
It's not. It's
Okay.
not. It's the same. It's just simply timing.
Okay. But you have to keep a lot of notes on.
We don't. So
Okay.
So fortunately, I have a good friend in the mortgage business who has assisted me in getting some information. Because if you ask a client, "Hey, do you have a federally backed mortgage?" They go,
"Oh,
They never know.
So I'm able to go out and pull the data and see if it's a federally backed mortgage, and we are then in compliance. So we independently fact check that on behalf of our clients.
Perfect.
And so a statutory 10 days of late payment, it's going to take me 10 days to get them posted. And so rent's due on the 1st, we post on the 8th. The notice will come due around the 19th or 20th. I usually get a court date the 26th or so. If we get a judgment, fastest lead time to get somebody out is about 7 weeks. On the high end, CARES Act, they file an answer and they're in one of our slower counties. You're looking at 10 weeks. So one of the things that our company is beginning to look at based on the laws passed in 2023 is increasing the minimum deposit from 1 month's rent to 1.5 months across the board to begin to mitigate more risk. The cost of things to fix, so the carpet, the paint, the shenanigans, 1 month's rent isn't covering those. And we're not mitigating enough risk on some of the higher end stuff. Unfortunately, the Real Estate Commission has ruled that I can't charge a different price for my Colfax studio than my Park, mansion. So we have to make a number that is, consistent, that doesn't create an additional barrier to entry to get my units rented for my clients, but at the same time mitigates that risk for those clients, if that all makes sense.
It does actually.
Mm-hmm.
That helps a bunch. So the other constraint I think is going to be, the high insurance and property taxes are going to be compressing everybody's cash flow. I can't think of very many times in the last 25 years when property taxes went down in Colorado. I struggle to think of any examples.
They go in one direction. Taxes, insurance, and HOA only goes in one direction.
Yeah. So unfortunately, that's probably not going to get any better anytime soon. So do you see anything on the horizon for other legislative stuff for next session that they might want to do to the landlords, or is it impossible to know?
It's kind of impossible to know. They really got done what they wanted to do in 23, 24 sans rent control. It's a hot topic. I and a number of my investors love the thought of rent control. I love it. Like, great. You tell me I can raise rent 5% every year.
Done.
Guaranteed
Guess
5% raise every year. If you look at the markets, New York, San Francisco, some of these larger markets that have enacted it, it has never benefited the tenant. It has only benefited the landlord with a long-term hold position.
Yep.
So I'm not afraid of it. And moreover, someone who is afraid of it is going to sell their unit. It's going to put one less rental unit in the market. Supply and demand, simple math, is unless we see a huge decrease in demand in the Denver market, which I don't believe we're going to,
No.
unless the supply keeps up. I am neither an economist nor a mathematician, but
Looks like rents are going to go up.
I think it's still an okay. Usually, I've always said it's a great time to be a landlord. I still think it's an okay time to be a landlord. So, provided you have patient capital
Yes.
and you're in it for the long term. If you're trying to be a landlord for 2 years and sell, Denver's not your market.
No, that's really well said. Excellent. All right. If you guys have questions, definitely drop them into the chat box here. You guys, when you download the presentation, you can see all these wonderful testimonials about how great we are. I won't need to read those out to you. And we talked a little bit about our investing options that we've got. So I think that's most of it. So if you want to talk about any of this with us, irontoncapital.com/review, you can pick a time to talk to us and we'll talk about what you want to figure out for your family's investment future. But let's do some questions if we've got a few that want to pop up. I can't believe we got through all those slides in 50 minutes. That was like amazing.
And we only had one person log off that didn't want to hear the investors.
Yep.
Yeah, that was pretty good retention. I thought we'd lose more than that. So we've got a lot of investors on the call today.
Bueller.
You guys
All
are an easy
right.
group.
Looks like no
You
questions.
guys are an easy group. Well, I think the most dangerous place in the world is being between an audience and happy hour. So if you have questions, call me tomorrow. Otherwise, I'll get out of your hair. And thank you for your time, guys.
Thanks, guys. Again, always
See you guys.
appreciate being here.
Thanks,
Thank
guys.
you.
We'll see you later.